What's going on, everybody? Welcome back to the channel. I appreciate you stopping by, spending a few minutes of your time here with me today. I wanted to talk to you about this quote that you hear a lot when it comes to trading the financial markets. If you ask anybody for a basic strategy, what is your strategy? If you had to bust it down to the bare bones, this is the strategy. You are trying to buy low and sell high. And it sounds simple enough, right? But when you open up your charting software and you look at a price chart, you can see that price is everywhere. It's all over the place. It's it's going up, it's going down, it's going sideways, it's going up, it's going down, and it's all over the place. How are you supposed to know when you're low and when you're high? How are you supposed to know when to buy and when to sell? And if you're buying low or you're buying high, or if you're selling high or you're selling low, how are you supposed to know this, right? Well, I'm going to break it down to you like this. Imagine you're going on a long journey, okay? And you don't know the territory you're going to be traveling, but you've been provided with a rudimentary map, a rudimentary map that gives you some landmarks along the way, right? And those landmarks serve sort of like a point of reference, or at least a reference point, right? So you can see here on my little drawing where we start on our journey, right? And we follow the path and we come to this body of water. And we can tell when we get to that body of water and we look at our map, we can sort of measure our progress, right? We can see where we started and we can see where we're at, and we can see how much further we have to go, right? Now, that's very important to understand, right? If you didn't have these landmarks, you wouldn't be able to measure your progress, and you wouldn't even know if you were headed in the right direction for the most part, right? You could end up going around in circles or backtracking without even knowing, right? Without a frame of reference, you're going to be lost. And the same is true when you go and open up your charting software and look at your price charts. If you don't have a reference point, you're going to be lost. Just like the example, if you were going on that journey and you didn't have a map, or you didn't have those reference points, you could become totally lost. There is, by the stroke of luck, you might make it to your destination, right? Or you might be able to make it there without the reference points. But at least without the reference points, you're not able to track your progress. You're not able to track the progress of price. So without a reference point, you don't know where you're at, meaning you don't know if you're high or if you're low, right? And this is something that has always boggled traders. A lot of traders, especially new traders, but even traders who've been trading for a while now, have a hard time figuring out when to buy and when to sell. They don't know if they're high, they don't know if they're low, and they have no idea how to figure it out. Well, I'm hoping that with this short video, you will have a clearer idea of what we're trying to do here. So, to get straight to the point, to keep it simple, your reference point when you open up your charts every day or at the beginning of every week is going to be the previous day's close or the previous week's close. So Friday's closing price if you're going by the week's close, or whatever day it is you're looking at the previous day's close. So if you're on Tuesday, you're looking at the closing price of Monday projected onto Tuesday, and Tuesday's closing price projected onto Wednesday, Wednesday's closing price projected onto Thursday, and Thursday's closing price projected onto Friday, right? And you're using closing price just like you would be using the lake or the mountain range on the map. You're using that as a landmark or a point of reference to know where you're at and to track the progress of price, to figure out if you're high or if you're low. So again, to keep it simple, to get straight to the point, not to waste any of your time, here are 3 simple steps to take before you try to decide if you're buying low or you're selling high, okay? So step 1, you need to go into a higher time frame and mark off the key areas on your higher time frame, either the weekly or the daily. You're looking for key areas, so you're looking for previous highs, previous lows, and you're looking for areas with equal highs and equal lows, all right? And you're going to mark off those areas, and remember that those are areas, those are not lines, right? You don't mark off a line and that line is very specific. No, it's an area. I like to mark off from the the close of the candle or whatever to the wick, to the tip of the wick, and that's how I mark off my areas or my zones, right? From that, you'll be at step 2. You're going to develop your higher time frame directional bias. After you mark off your higher time frame key areas, you're going to be looking at the current price action to develop a thesis, to develop an idea of where you think the market is going based on those areas you marked off, right? Those areas of equal highs, those areas of equal lows, there are buy and sell orders there that are going to be absorbed by the market at some point. And we're looking for some idea to figure out which area we're the most likely to head to, right? So after you have that higher time frame directional bias, you can go down. Now you're looking for an opportunity either on the day or on the week, however you're trading, to buy low, which means, a different way to say buy low is to buy it at a discount price, or else you're trying to sell high, depending on which direction you think that we're going on the higher time frame. You're going to sell high, and another way to sell high is at a premium price. You want to sell at a high price, a premium price. If you're buying low, you're at a discount. That's how I want you to start, kind of framing that. You want to get it at a discount. That's important for the next slide that we're going to take a look at here. So here I've drawn out just a random day, okay? But this day, in this example, this is a day that we've zoomed in on inside of a bullish higher time frame bias, right? We have already went into our weekly and our daily charts and developed our directional bias, and we think that price is going up, meaning that we are expecting higher closes. When price opens, we're expecting price to close at the end of the day higher than when it opened, okay? Right? Price is going up, so that's what we're expecting. So you can see this day I've drawn out the price action, and I've also projected the low of the day and the high of the day across the picture, and I've also put a dashed red line representing the closing price of this day that we're inspecting, okay? And don't worry about the other stuff. First, let's look at the price action on the day. We see that day opens up, trades lower before ultimately catapulting up to the top of, our chart here and closing. And it closes up high, okay? This is what we want to see with our higher time frame bullish directional bias, right? And so look at what it did. At some point in the day, early in the day, price was at the low of the day. And we're just going to put a simple number on there. We'll call it 100. That price is at $100 at the low of the day. And when it closes at the high of the day, we're at $200, right? When it closes up there, closing price. Let's say it closes right at $200. So it's up $100 in one day. The price of whatever we're looking at right here has went up $100 over the course of the day, right? So when the next day opens, it opens where the previous day closed, right? We begin where we left off. So we open up high. We're up there at $200, right? So we're at a high price according to the prices we have from yesterday's trading, okay? We're at a high price. But as soon as we dip below closing price, you're automatically in a discounted area, okay? And why are we at a discounted price when we are below closing price? Well, let's go back and think about it, right? That day, day one, at the low of the day, was only $100, and it closed at $200, right? So, and according to our higher time frame directional bias, we are expecting a higher close than the opening, right? We're expecting price to trade higher based on our higher time frame bullish directional bias. So that's what we're expecting to happen over the course of the week or over the course of the day. So if price opens where the previous day closed, then when we open on day two, we're going to be opening at $200, okay? And that's expensive according to yesterday, right? So as soon as price dips below that 200 level, you're at a discount. Even if it's only 190, you're still at a discount because price is going to close higher than it opened. So if you're buying below closing price, you're getting it at a discount. Think about it. If price drops from 200 back down to 150, right? You just got $50 off. You just got a very low price, especially if price is going to go back above closing price and close somewhere higher than that. You understand what I'm saying? So using smart money terms, when day two opens and it trades lower, it trades back into day one's range, back down to 150, that is the opportunity for smart money to buy low at a discounted rate, okay? And when it gets up and it's above closing price, they can sell it at a premium because now it's above closing price. We're trading above $200. That is a premium price according to yesterday's day one price action. You understand what I'm trying to say here? So I hope that makes this a little bit clearer, right? And if you were on a higher time frame and you had a bearish directional bias, meaning you think that we're going to be expecting lower prices, we're going to be expecting a lower closing price than the opening price, then we're looking for the opposite. If we want to sell at a premium price, we are looking for price on the new day to trade above yesterday's closing price, go back into a premium area, a higher price. That's the opportunity for smart money to get in and sell at a premium rate, okay, and get the most bang for their buck, okay? And so I hope that clears up a little bit of confusion. You come into your charts and you use closing price as your reference on the day or on the week, and that is going to let you know where you're at. And if you just go back and inspect your charts and see this for yourself, it's something that once you see it, you can't unsee it. It's going to open your eyes to something new. And if you keep going, you keep checking this out, you know what I mean? Eventually it's going to click. And you will have no problem knowing if you're low or if you're high on the day or on the week, right? You won't be lost when you get to the charts. You'll know exactly where you're at, okay? But it's very important that you don't skip those steps 1 and 2 to form that higher time frame directional bias. That is very important, okay? So, anyway, until next time, I hope that the markets trade in your favor. I hope you can develop some patience to wait for these setups. I guess another important part here is like, the question might be, when would we get in though? Like, when do we want to buy here in this discounted area? And that's a pretty simple question to answer, okay? You're looking for a price to go down back into the previous day's range and then start trading higher. So you're looking for a low of the day formation similar to the formation shown here on the day one chart, right? Where it says low of day. You can see right there in the middle of the chart, we have sort of a triple bottom formation, and that would be right into the London Open, right in the London session. That's when that low is going to be given. And it's not always going to be given there. It might be given in New York. It might be given in Asia. You know, if it's given in Asia, we might not pull back very far. It might be a shallow pullback before we just have a trending day or something like that, right? But you're looking for a low of the day formation, a pattern, a low of the day pattern. It might, that might look like a bullish reversal pattern on a lower time frame or something like that. It might be like a head and shoulders going into the London session, or a W formation at the low of the day going into the New York session or something like that. You're looking for a pattern, somewhere in there in a session window. It's going to be in a session window. And that's how you're going to know when you want to get in, okay? You don't want to buy it just at any random time. You want to make sure you're looking at a session window and you're paying attention to literally what time it is. Like if you're at the beginning of a new hour or the end of an hour or the beginning of a new 15-minute candle, you want to time your trades like that. Maybe the next video will go more into detail with that. So, you guys, let me know in the comments if you like this video, and if you have any questions, or if there's something that you want to ask that you might want me to go over in the future, just go ahead and drop the comment. It might not be the next video, but we'll get there. All right, I got a whole plan for us. We're going through this one by one. All right, anyway, until next time, I hope you continue to free your mind.